Welcome back, everyone, to Alpha Beta Soup. I'm TXMC. Today, we will talk about the U.S. consumer. There's a lot of chatter going around in FinTwit and the econ world about the strength of the U.S. consumer, which is a vital cog in the world economy. So we'll take some time to really unpack what I think that means. I'll show you various data points related to consumer finances, and we'll try to get an idea of what we think the truth of it is. So don't go anywhere, we've got several things to talk about. If you enjoy my content, make sure to give my video a thumbs up and subscribe to the channel. I greatly appreciate all of your support. And please be aware, this YouTube channel and my official Twitter are the only two places to find my content. If you are receiving emails or DMs from someone claiming to be me, that is not me. I will never ask you for money, I won't ask you about your portfolio, and I don't have any kind of private group or Telegram. This is the official home. So with that out of the way, let's get into today's video. We'll check in first with Bitcoin here on a monthly chart. We're still consolidating down below structural range support where I would consider around 35,000. We've just been really watching this consolidation down here to see if perhaps it provides the same kind of deviation that we got to the top side back in October and November before a move back to the top of the range. But with everything going on in the economy, I think that this kind of price action is probably a low possibility, but still it's important for us to look at the price chart to have a general idea of where the momentum is, which is currently to the downside. And, from these higher time frames, which is where I choose to look at this, especially now, especially with all this uncertainty, without really being sure where rates are going to go, where the economy might follow along with that over the next couple months, it's really critical for me to keep high time frame perspective. And right now, the high time frames look like garbage. And when you look at this monthly chart, there's just almost no support down to here. This is just a big open area of nothingness. And there are some moving averages people use that you can probably put here in the middle somewhere, like like a 200-week moving average. I know people like to look at that. And when you look at the 200-week in comparison with some of these high time frame structural resistance areas, we really are in the middle of nowhere. It's not particularly good. There's no real place to gather support from a monthly perspective. When we go down to the weekly time frames, it's a little bit closer to the structural bottom. Maybe you don't call it there, maybe you call it back here. Whatever line you actually choose, around 32,000 or so, that would probably be the place to get back to on a weekly perspective. Find it as support before we move back up, probably to this range median would be the best that I would think you could hope for if you're even able to break over 40K, which itself has some areas of resistance. Just purely from a price action perspective, there isn't much to take home here. We're really just watching this slow, painful consolidation down here below 18-month support. And I think we're just going to continue seeing this while the economy figures out where we're going to go over the next few months. Maybe we get some upside. Maybe we're actually able to fight back up in here to the 40s. But that's not really that important to me right now. Who cares about ripping 10 or 15%, even 20% from these current lows? It doesn't really matter to me. I'm not a short-term trader, and if you are, you're probably not getting your market edge from me. I don't find very much compelling here from a technical perspective, and it's part of the reason why I haven't been looking at the price chart very much lately, because I don't think it's going to be the home of signal. Maybe we go lower than this, maybe we don't, and we won't know if this is really the bottom until hindsight. I hear a lot of people calling bottom. They profile this capitulation here with its high volume. Perhaps Bitcoin has already experienced its own deleveraging, and it's just going to go sideways until the economy sorts itself out. Perhaps that happens, but we can't really know that with confidence, and it won't be until hindsight that we're actually able to say whether or not this marked the bottom. From my perspective, that isn't my base case, and I'm still very open to the idea of properly testing this level at least one more time. A quick peek on equities here, also on a monthly time frame. Still has a lot of work to do, still not particularly attractive. Now there are some dojis that formed here on the May candles, and in a lot of cases people might identify that as a reversal point, but I think it's hard to call for that here. Maybe it means we get some brief upside, maybe June and July end up not being complete doom. But I do think the economy itself has considerable more stress to work through over the next quarter or two potentially, depending on on how quickly things unwind. So I'm not ready to call any kind of a bottom here just because we've got a doji on the make handle. But what I really want to talk about today is the consumer, the US consumer, which powers the global economy. Since 2010, consumer spending has been more than 2/3 of US gross domestic product almost every year. And it's that spending that helps to bolster the economy. Now, what we explored in the previous video was the housing market. We looked at declining month-over-month sales. We also saw a precipitous rise in the supply of homes based on the sales rate. And we're currently looking at a 9-month supply of homes, which is a historically high measure. Down here at the bottom of my screen is another look at the supply of monthly homes, this black line. And you can see periods where it's above this dashed line, which means that there's at least 8 months of supply of homes on the market. Well, if you look back at times in history where we have had a higher supply of homes than 8 months, it's been in recessions. That's what these gray bars mean up here at the top. And you can see each of these peaks above the dashed line have aligned with a recessionary period. I don't know if that means we're heading for one now, but we're seeing slowdowns in the housing market. There's a bunch of units that are under construction that are not yet completed, which will be hitting inventories, which are already rising. We're seeing the sale of homes, the rate of them decline. Then when you couple that information with the news coming out of CNBC today, it really encapsulates the slowdown that's hitting the housing market, and it could accelerate quickly. Applications for new mortgages fell 7% week over week and are down 21% year over year. Demand for new mortgages is at the lowest point it's been in 22 years, according to the Mortgage Bankers Association. Refinance demand is also falling 6% week over week and is down 75% from where it was a year ago. A lot of mortgage holders have already refinanced, but again, we're just seeing slowdowns in housing. Falling demand for mortgage applications, rising inventories along with rising home prices and rising mortgage rates. That spells a slowdown in the housing market. So what is the consumer saying? We keep hearing news out there. I see a lot of tweets about consumer strength. And many times they point to things like this chart here on the right, which is allegedly showing over $2 trillion of consumer quote unquote savings sitting in bank accounts. But as I will show you here in a bit, this number is misleading because what we don't see here is the distribution of this money amongst the consumers that are holding it. This implies that the American consumer as a whole has a bunch of cash sitting in reserve waiting to be spent into a weakening economy that would help bolster GDP, support growth, and we don't have to go in a recession. That's the narrative coming out of Jerome Powell, coming out of Washington, and coming out of places like Bank of America, which have been putting out these consumer reports lately, claiming about a lot of consumer strength. Here is the most recent Bank of America report. And when you go through this report, some of the stuff sounds good. They say aggregate credit and debit card spending up 9% year over year. Credit card spending alone is up 16%. But when you dig into this a little bit deeper, they even admit it is noteworthy that the spending growth rate is less than the current rate of major inflation measures, namely the CPI and the personal consumption expenditure, PCE, which are both at 8.3% and 6.3% year over year. When you compare that to the per household increase of only 4.3% year over year in spending, what that shows, what it's suggesting, is that when you adjust for inflation, real spending growth for households has slipped into negative territory. So what this is saying is that while spending has been rising year over year, the inflation rate is rising even higher. So it's inflating the top line numbers. And in truth, when you adjust it for that inflation rate, consumers are spending less. Money is still going out, but it's being used on fewer goods by the nature of inflation. And that is a sign of weakening consumer buying power. Additionally, there's another report that comes out from the New York Fed. Each of the Federal Reserves has a research division, and they put out a lot of really cool reports, and I feel like very few people actually look at them, but there are some really interesting nuggets in here, and there's a couple of things we'll pull out of this one. This is their household debt and credit report. The first thing I'll point out here is that number of accounts by loan type is showing an explosion of credit card accounts in the last couple of years, and now total credit card accounts is at its Its highest point going back to this chart's beginning in 2003. So tons of credit card usage by the consumer, a little bit less so of other loan types. Home equity credit has been declining, but credit card use has been rising. When we look at the number of new accounts, so this dark blue line here in the center is the number of accounts opened in the last 12 months. Look at this jump. This is a number of new credit accounts opened in the last 12 months. It's the highest rate since 2008. So credit in the consumer sector is expanding aggressively, while we're hearing reports that they have plenty of savings. And when you start to dig into some of the data about delinquency, it's showing signs of softening. So we've had multiple years, many years of downtrends in total delinquency, right? Just the summation total of delinquent accounts is reducing. But what we've seen here, basically since the beginning of 2021, this level has flattened off. You see now we've been declining since 2009. It started to flatten out here, but still we were fluctuating and seeing general declines. But here since the beginning of 2021, this level has flattened out, and we're seeing this green portion growing, which is the 30-day delinquent cohort. So we're seeing more 30-day delinquent accounts, and the total number of delinquent accounts is no longer shrinking. This is where a reversal in credit conditions starts. This is how it can look, right? At the beginning, it seems innocuous. It's just a couple of flat prints. Look at the multi-year trend. Yeah, but when you think about the market in context, this could be a harbinger of something worse. We need to keep our eye on this as we move forward through the summer here and ensure that delinquency doesn't explode. Here's another look at delinquency, this time by the different loan types held at the various banks. Now, since 2009, all these lines have generally been declining, right? There's periods where it rises and then falls. Here in 2020, delinquency fell off a cliff. And in part, this student loan drop off was because of the forbearance, because people were not required to continue paying their student loans. And so delinquency rates basically went null and they've fallen off a cliff. But if you look at the curves of all of these lines, basically since the beginning of last year, they're all starting to soften and curl upwards. Credit card is in blue, auto loans in green, mortgages in yellow. You see all these curling? Again, similar to the chart we were just looking at, this is where a reversal could begin. This is what it can look like in the beginning. It seems like nothing at first. It seems like a general softening of credit conditions, maybe a little tick up quarter over quarter, but we need to keep our eye on this. And if these lines start rising, while they are still at historically low delinquency rates, if we see increases in this value alongside continuing tightening economic conditions, if we, God forbid, start seeing layoffs, these numbers will go up. We can also see a small uptick specifically just in mortgages. So this blue line is showing mortgages that are transitioning to 30 or 60 days late from previously not being so. You can see there's a little uptick here after many years of downtrend. We've seen 2 quarters here of a rise and then a sideways print. So I'm keeping my eye on this for the next report to see if this continues to rise. And there's a reason these things matter to me. So look, when I hear about consumer savings, like this chart here on the right, that's suggesting that there's $2 trillion of savings sitting in the bank accounts waiting to be used for a rainy day. But then I go look at a data point like this one. So this is coming straight from the Federal Reserve. This is the number of checkable deposits and currency. Now, this is a little different from savings. I asked Lynn Alden about this, and she confirmed that total savings is probably more accurate to be looked at from M2 money stock, which is broad money supply. However, checkable deposits and currency are the more faster versions of money, right? That is actual like checking account balances and cash, the most liquid forms of money that people have available to them. That's represented here on these lines. Each of these lines is a wealth cohort, and what we're looking at is their total share of the pie of these checkable deposits. Well, the top 1% is this dark blue line, and if you'll notice, from 2020 to now, they are the only group who has grown a share of this pie. They've grown a considerable portion of it. They've grown from 16.9% to 29%. 29%. So 13% of all of the checkable deposits and currency over the last 2 years was taken away from lower income groups and given to the top 1%, or at least it has transitioned into their possession. Now, a lot of factors go into this. The wealthy typically don't sit on large amounts of cash. Most of their wealth is tied up in assets, be it financial assets, hard assets, whatever. So usually they don't necessarily have the biggest share of checkable deposits and currency. The middle income groups tend to. The orange line is the top 10%, the red line is the top 10 to 50%, and this blue line at the bottom is the lower half of incomes. The lower half of incomes are in mostly cash, but by the nature of having low incomes, they don't have a large share of the pie. That's part of the income inequality we have here in America. But the real takeaway from this chart is the change in the top 1%. So when I see data that points at this, that begins in 2020, and it's saying that there's $2 trillion of excess money sitting with the consumer, but then I look over here and I see that every other group lost market share of checkable deposits, and the only one that gained market share was the top 1%, that's alarming to me. And that suggests to me that perhaps a chart like this isn't a complete story or is straight up wrong. Because when we look over here, this really suggests that most of the liquid cash sitting around is sitting with the wealthy who don't exactly need it. And other groups like the 10 to 50 percentiles or the bottom 50%, they've actually seen their share of the pie reducing. So that is a concern for me. To help corroborate the fact that we see the 1% gaining most of the cash, here are a couple of metrics for consumer finances, right? So up at the top in blue, we've got the personal savings rate. In orange in the center, we have real disposable income year over year. All of these are year over year. And at the bottom, we have total consumer credit loans. Each of these represent a different facet of consumer financial strength. We've got money in the bank, money coming in, and leverage. Up here at the top, personal savings rate, it ballooned in 2020. We sent a bunch of people home. We gave them a bunch of extra money. Their spending patterns changed. And in a period of time, personal savings exploded. But what we've seen since the middle of last year, since the middle of 2021, personal savings is now negative. And so we're seeing a minus 65% year over year savings rate from where it was before. That means the rate itself is down 65%, not that total savings are down 65%. But the rate at which people are able to save is actually negative. It's reducing. They're getting squeezed. Here in the middle, we've got real disposable income. This is disposable income net inflation. So this is extra money available to consumers. It is also negative. It is declining, and it has been declining since the middle of last year. There's a theme going on here. Middle of last year, that's when we got the first big ugly inflation prints. That's when people started to believe the Fed was going to have to tighten, even though they were still trying to convince us that inflation was transitory in the face of 5 and 6% CPI prints. But alas, savings began to decline, real disposable income is negative, and consumer credit is now rising. The deployment of consumer credit declined into the pandemic, and since the beginning of last year has been on the increase, and it's now up 13.5% year over year. Total consumer credit. And when we revisit this chart that we were just talking about a few minutes ago, you can really see how credit card account growth has been steadily rising and has not been deterred at all by economic tightness. If anything, it has been accelerating in rate of change terms. And these things are important, right? Because all of these different factors about consumer health are playing into their sentiment and their confidence. And consumer sentiment is currently at recessionary levels. So what I've got here on the screen is the unemployment rate colored by sentiment. So the University of Michigan has a sentiment survey that they send out once a month, and it is color coding the unemployment rate here. So when you see red, that means sentiment is very low. When you see blue, that means sentiment is high and confidence is more positive. Well, the unemployment rate, as you can see, can stay low until we get really close to a recession. Recessions are these gray bars. Unemployment can stay pretty low until we get to a recession. Right now, unemployment is very low. It's at generational lows. However, what is not common is for unemployment to be at lows and sentiment to also be at lows. If you look where unemployment hits its bottoms, historically, it's usually when the line is blue. Most of the time. That means that employment is high, everyone has a job, sentiment is positive, people are feeling good about the economy. Then usually unemployment begins to rise, sentiment deteriorates, the line flips to pink, and usually a recession starts when unemployment begins to skyrocket. Those things tend to go along together. Well, curiously, we are at generational lows of unemployment, but the sentiment is in the gutter. It's at recessionary levels. And if you look back through time, the only real period we have to compare to this is the middle 1970s, which were an extremely inflationary period of time. And we went through a couple of recessions in the 70s. We had one in about 72, 73, and there was one in 1980. And these periods are the only place on this chart that I could really compare to where you see consumer sentiment deteriorating before a rise in unemployment. What we don't see on here, what there is not a data point to show, is a period where consumer sentiment reached recessionary levels and unemployment stayed low and then sentiment improved through some other factor. We do not have a history of that in the last 70 years. If we're just talking about probabilities here, we're likely headed for a recession. We already showed consumer strength is not what it appears to be. They don't have as much excess cash as is being claimed. Most of that is sitting with the top 1%. The housing market is beginning to slow down, which provides a wealth effect for a lot of Americans. They're deploying more credit as real disposable income is negative and the savings rate is dipping negative. All this while we still sit and stare at sub 4% unemployment. Now, this metric is not perfect. The unemployment rate has its own flaws, but it is the metric that the people in charge look at. So it's important that we have an idea of how it has behaved in the past. And the way it has behaved is that it can stay low until things really hit the fan, and then it can explode. It can explode upward. So the fact that we're sitting at low unemployment with gutter sentiment is a red flag to me. And I am on high alert over the next couple of months to watch employment. We're already hearing about places like Walmart and Amazon talking about how they have too much staff. Just a couple of days ago, Target mentioned that they're going to attempt flash sales to try to liquidate some of their excess inventory. If that doesn't work, friends, they will be forced to cut jobs to meet their margins. They have no other choice. If you can't sell the products, you've got to cut input costs. And the easiest place to start is with labor. So I hope that I've been able to paint a picture for you today to show you that the consumer does appear weak. Their savings are being stretched. The goods that they are required to buy, gasoline, eggs, meat, those things are at generational highs and they're cutting into discretionary budgets. So retailers like Target that are announcing flash sales, they may not find a consumer appetite there to buy whatever junk consumer goods they're trying to offload because people are trying to survive. And if we see unemployment begin to tick up because some of these companies that have already announced hiring freezes and the rescinding of job offers, if that rolls into an actual unemployment wave, this kind of weakness that we see here, where most of the checkable deposits have gone to the top 1% in the last couple years, this kind of weakness will come to roost. And the powers that be will be forced very quickly to reckon with reality because they have been behind the ball this entire time. They use lagging, imperfect indicators to make their decisions. And when you peel back the onion and you really look inside the economy, there are warning flags everywhere that we are not out of the woods yet, which makes me hesitant to call bottom on any asset. I am not trying to participate in this market, and I am patiently observing economic fallout that may be on its way to us. The Fed does not have a history of wisely backing off from their plans when it appears that the economy is teetering. They usually continue to march ahead until something breaks. But in this case, it could be a number of things that break. We didn't even talk about corporate credit. We haven't talked about the bond markets. There's much else that we could continue to unpack. Today was really about the consumer. And I want you to keep in mind that when you hear things about them having a bunch of money in the bank, when you hear things like the consumer is continuing to spend, Bank of America is telling you right here, inflation-adjusted spending for households is negative, regardless of what the high-level top-line sales numbers are in an inflationary environment. What does this mean for Bitcoin and risk assets? Well, it doesn't mean anything good, I can tell you that. Now, maybe Bitcoin doesn't necessarily go lower. Maybe this proves to be the bottom in hindsight. We can't know that right here. We won't know this for several more months. But what we can assume is that if we are looking at potential unemployment, if we do actually head into a recession, which regardless of what Powell says is very possible, if we do run into those things, risk assets are not going to perform well, and the liquidity needed to sustain the valuations that we're seeing in the crypto market, the liquidity simply won't be there, not in this environment, and we must wait for a sign that it will return. And it likely won't be until the central banks are forced to back off of their hawkish policies. This week, we've got a couple of things to look out for, namely unemployment on Thursday and then the new CPI print on Friday. We will reconvene in a couple of days and talk about those things and whatever else is unfolding in the markets. So until then, make sure you follow me on Twitter at TXMCTrades. I know we jumped around a lot today, looking at a bunch of different consumer data points. I hope you followed along with me. If you have any feedback or questions, or you'd like to share your views on the economy, please leave them in the comments below. I do manually go through every one of my comments. It's the only way to keep the bot spam out, so I will see what you leave for me. And we will give all this a few more days to unfold and reconvene to talk about what happened with CPI, what the market reaction was, and whatever else happens to be going on. If you enjoyed this content, please give my video a thumbs up and subscribe. I really appreciate your support. And be sure to share this with any of your friends that you think might find it valuable. And that's where we'll leave it today. We will chat again in a few days. So until then, take care of yourselves, friends. Be kind to each other, and we will meet again very soon. Cheers, everyone.